If you want to become a smart money trader, you first need to learn the law of supply and demand. According to Wyckoff theory, supply and demand determines the price direction. If demand is greater than supply, the price will rise. If supply is greater than demand, the price will go down. And if supply and demand are in balance, there's no significant price change. This is one of the most basic principles of the financial markets. Now, in any market, there are two types of participants: aggressive and passive. Aggressive traders are the ones that use at-market orders. They have urgency to enter and attack the best price possible. This type of aggressive orders represent the real engine of the market, since they are the ones that initiate the transactions. Passive traders are the ones that use limit orders. This is important because the interaction between aggressive buyers, aggressive sellers, passive buyers, and passive sellers is what moves the price. The main point is, an aggressive participation of traders will produce a change in price. Passive orders have the ability to stop a move, but not the ability to make the price move. For the price to move upwards, buyers have to buy all the supply orders that are available at that price level, and also continue to buy aggressively to force the price up, to find new sellers to trade with. Passive buy orders cause the downward movement to slow down, but by themselves cannot drive the price up. For the price to move downward, sellers have to acquire all the demand orders that are available at that price level and continue to push downward, forcing the price to go in search for buyers at lower levels. Passive sell orders cause the upward movement to slow down, but don't have the ability to drive the price down on their own. So the price needs aggressiveness to move, but it's important to take into account also the lack of interest from the opposite side. An absence of supply can facilitate a price rise, just as an absence of demand can facilitate a price decrease. In a rising market, as long as the buying initiative is able to consume all the liquidity or the supply found at higher levels, the price will continue to rise. On the other hand, in bear markets, as long as the selling initiative is able to consume all the liquidity, the demand found at lower levels, the price will continue to fall. At the moment of a market turn, we will always have a three-step process: exhaustion, absorption, and initiative. During an uptrend, in the exhaustion phase, there's a lack of interest of the buyers to continue buying. During absorption phase, you'll see more and more sell orders placed by the smart money. During absorption phase, there are many passive sellers. The initiative phase is characterized by aggressive selling. More and more aggressive sellers are entering the market. During a downtrend, in the exhaustion phase, there's a lack of interest from the sellers to continue selling. During the absorption phase, you'll see more and more buy orders placed by the smart money. And during this phase, there are many passive buyers. The initiative phase is characterized by aggressive buying. More and more aggressive buyers are entering the market. And these interactions between aggressive and passive buyers and sellers create supply and demand zones on a chart. So if you're a trader who wants to improve your trading performance and trade along with the big players, the first step is to implement supply and demand concepts into your trading strategy. We already established that the market is driven by the actions of smart money. By identifying the areas where smart money has placed their orders, you can trade along with them and benefit from their influence. A supply zone is where smart money has sold at higher prices, creating a bearish pressure that pushes the price down. A demand zone is where smart money has bought at low prices, creating a bullish pressure that pushes the prices up. These zones act as potential turning points in the market, as smart money often leaves pending orders at these levels to fill their remaining positions. So in theory, if prices revisit these supply and demand zones, it's highly possible that they will be rejected. Now, to determine the optimal supply and demand zones, first you need to search for sharp price increases or decreases, which indicate the involvement of smart money in the market. These movements are referred to as market imbalances, significant price shifts in one direction. To identify demand zones, look for fast impulse moves, keeping a close watch on big green candles. These candles should have long bodies and minimal wicks. Once an impulse move is identified, you need to locate the base of the zone. Place a line at the high price of the most recent red candle, preceding the impulse move, and another line at the most recent swing low formed at the source of the move. To find supply zones, look for fast declines and red candles with extended bodies and minimal wicks. Then find the most recent up candle before the sharp down move and place a line at its low price, along with another line at the most recent swing high formed at the source of the move. In theory, the price is likely to reverse once it returns to these supply and demand zones. But to effectively trade these zones, it's important to understand the two key rules to identify the right zones on the chart. The first rule is to trade only fresh and untouched zones, because supply and demand zones are one-time use. Once price hits a zone and reverses, the zone loses its power, and the probability of it causing another reversal in the future is lower. The second rule is that recent zones are more important than older ones. Supply and demand areas that have been created recently are far more effective than those that were created a long time ago. There are 4 different types of supply and demand zones, based on how the price approached and left the zone. These 4 types can be classified into 2 groups: continuation structures and reversal structures. First continuation pattern is the rally-based rally, which forms a demand zone during an uptrend. The market structure begins with a rally, followed by a consolidation, and ends with another rally, which creates the demand zone. The second continuation pattern is the drop-based drop structure, which forms a supply zone during a downtrend. The market structure begins with a price decrease, followed by a consolidation, and ends with another price decrease, which creates a supply zone. In both cases, if the market returns to these zones, the price is expected to move in the direction that created the zone. The drop-based rally is the first reversal structure, which forms a demand zone in a market. This zone is located where the market changed from moving down to moving up. The second reversal structure is the rally-based drop pattern. This forms a supply zone, where the market reverses from moving higher to moving lower. Again, if the market returns to these zones, the price is expected to move in the direction that created the zone. The main advantage of supply and demand trading is that it helps you to understand the market structure and market dynamics much better. This is the first component in your smart money trading plan. The law of effort versus result is another fundamental principle of Wyckoff theory and one of the most important concepts to follow the smart money on any market. This concept states that the effort made by the aggressive and passive buyers and sellers will be reflected in the price movement of any market. The principle is based on the idea that the market is a battle between buyers and sellers, and the direction of the market is determined by the side with the greatest effort, which is represented by the volume. High volume indicates strong market participation, while low volume, weak market participation. Volume is very important because it provides